We're going to talk today about riders and supplementary benefits. And you can think about riders and supplementary benefits very similar to options you might have on buying a new car. And so riders and supplementary benefits allow you to customize the basic plan that you have. And with these riders and additional benefits, you're able to have additional coverages that would fit your specific situation. So now let's start with riders. There are many riders available. Many companies have riders that are specific to what they're offering. Your textbook covers 4 common riders. And so we're going to talk today about the paid up additions rider. We're going to talk about term insurance riders, accidental death benefit riders, and guaranteed insurability benefit rider. Now, what's important to remember the difference between riders and benefits. Riders are giving you additional coverages that become effective upon death. This is different than a supplementary benefit. Supplementary benefit, which we'll talk about later on, will give you coverages that affect you while you're still alive. And so those are the differences between a rider and a benefit. A rider gives you additional benefits on death. Supplementary benefit, additional benefits while you're still alive. So let's look at 4 common riders. First of all, paid up additions rider. You may recall when we talked about participating whole life insurance, I said to you that one of the options with the dividends that you receive on a participating whole life policy is that you can buy additional insurance, same as your base plan, additional paid up additional insurance. This rider offers you the ability to actually buy additional insurance, additional paid up additional insurance, and you would actually be paying for that out of your own pocket. You wouldn't be paying for that because of a dividend that you would have received. So it's similar to the paid up additions rider that you get with a dividend option under participating whole life. So it can be added to whole life and universal life plans, although I would say in my experience, I have never seen a paid up additionals rider added to a universal life plan. Nevertheless, according to the text, these are options that are available. And so when you buy these additional riders or benefits, you're actually going to be paying a premium for that right, the right to get a paid up additional rider. And so like the paid up additional single premium rider that you have on participating whole life, same concept here. The single premium you pay buys an additional amount of permanent insurance. Now there are minimum and maximums that under the rider that they allow you to buy. In other words, you buy at least this much every time the option comes up, and there's a maximum on it. And there would be an overall cap in terms of how much additional insurance you can buy. Now what's always good about these additional these riders is that any additional coverage that you want to buy, you do not have to provide medical evidence of insurability at that time. So paid up additions rider, you're buying the same as the base plan, and primarily you see this with whole life plans, not as much as I said on universal life. Second type of rider that we want to cover are term insurance riders. And so on your universal life or on your whole life plans, you can add additional coverages on someone else's life. And so it's additional term insurance for a specific period of time. So someone can have a base plan of, for example, $100,000 of whole life, and they can add a rider, an additional coverage, which would be a term insurance of, say, another $50,000 or another $100,000 on top of that. So their total death benefit would be $200,000, $100,000 for the term insurance rider and $100,000 for the base plan, which might be a permanent plan. That rider that you added, because it's term in nature, you still also have the flexibility of converting that rider at some point in time to a permanent plan. So for example, someone who has limited cash flow, only has X number of dollars to purchase insurance, let's say they needed $200,000 of insurance. They could in fact buy $200,000 of term insurance. They could buy $100,000 of whole life insurance with $100,000 of term rider, or they could buy $200,000 of whole life insurance. So they still have $200,000 of coverage. However, because the first part was primarily term, it would cost them less. The third one was primarily whole life. It would cost them the most. And in between, you would have that combination, which is a $100,000 base plan with a $100,000 rider. So to manage the cost, if you need a certain coverage, you can have combinations of a base plan and a rider. Now that rider also can be on another life. So I can have a policy on my life, where I am the life insured, and I can then decide to add a term insurance policy on my spouse's life if I wanted to, or I could have it on my children's life. We have something called a family rider, which covers the spouse and up to usually 3 or 4 children. So riders can be added on. They are term in nature. They cannot, obviously if the base plan expires, then the rider expires. You cannot have a rider extending longer than the base plan. And so a lot of people will use riders rather than buying another separate policy, because you still have one policy. You're only paying one policy expense, as opposed to if I had a $100,000 permanent plan and a $100,000 term insurance, I would have 2 policies and 2 policy fees or 2 policy expenses. By combining that into one policy, I would still get the $200,000 of coverage, but I would only have to pay 1 policy fee each year. So there's an advantage to adding a rider. And again, if you no longer need the rider, you can in fact delete it. Third type of rider, accidental death rider. Now, accidental death pays an additional lump sum in the event that the person dies by an accident. So if the life insured dies by accident, they're going to pay out an additional death benefit. So if, for example, you have a life insurance policy for $100,000, again, base plan, and you have a $100,000 accidental death rider, if you die by accident, the total payable is going to be the $100,000 base plan plus the $100,000 accidental death rider. If in fact you died only of natural causes, then only the base plan would pay out the $100,000 to the beneficiary, because the accidental death rider wouldn't apply since you didn't die by an accident. So it can usually be bought in units of 25,000 chunks, I guess, or units, I guess is a better word. And so I may have a $100,000 base plan and add 2 units of accidental death, which would be $50,000 in total. Now, what's important in accidental death rider, death, if you are in an accident, death must occur within 1 year of the accident in order for the accidental death rider to pay out. So a lot of people have a situation where you may be in an accident and in fact you're still alive, you're in hospital, but in fact if you do not survive up to 1 year, then the accidental death benefit, if you don't survive, it'll be paid, but if you survive beyond 1 year, then the accidental death benefit no longer applies. So coverage usually expires around age 60 or 65. So if you bought a policy at age 40 with an accidental death rider, at age 65, if you still have that policy, the rider will in fact be terminated for the accidental death. The base plan will still be in place as long as you're paying your premium. The fourth rider we want to look at is something called a guaranteed insurability benefit. And so guaranteed insurability is exactly what the title says. You are guaranteeing your insurability for the future. So a guaranteed insurability benefit, you might see it as a benefit rider or rider in terms of the name, but it's the option to buy additional coverage in the future without providing any medical evidence. So you are today guaranteeing your future insurability. So regardless of what happens to you with respect to your health in the future, you can buy additional insurance coverage if you have a guaranteed insurability rider in place. There are some limits on how many times you can exercise that option and how much you can buy. And every time you buy the new coverage, it's going to be at your then attained age. So the guaranteed insurability benefit gives you the right to buy additional amounts of insurance at times in the future, and you will pay for that at your then attained age. Remember, we talked earlier in the previous segment on the 3 ways to calculate your attained age. It varies by company. So anyhow, guaranteed insurability rider is something that most people, if you get it, you're locking in your ability to get insurance in the future.